Hi guys, welcome to Money Control. I'm Karunya Rao. It's Friday, 4 p.m. and it's time to get you the market's weekly latest edition. Joining me today is the Senior Fund Manager from ICICI Prudential AMC, Mr. Parag Thakkar. Parag, thank you so much for taking
Thanks.
time out.
Thanks a lot to all your viewers.
You know, I want to start with your view on what's happening in the markets. It looks like we're playing a game of snakes and ladders. One day, the market climbs up a fair bit. The next thing you know, again, a 300-400 tumble down. And that has been largely the trend for the last 1-2 weeks. What should investors make of it?
See, I'll tell you, from the month of November, there is this overhang of liquidity tightening by Fed, US Fed, right? So interest rates in US are on the rise. US bond yields are about to reach 3%. We are very close to 3%. On the other hand, there was a Russia-Ukraine thing overhang again came up, which actually boosted the fears of inflation, or even you can say stagflation at some point. And it creates margin pressure for so many companies because all commodities have shot up. So there are from the month of November, I can see there are so many headwinds. In fact, market is very resilient, I would say, because of the domestic flows and because domestic retail investors have kept faith in the market, and there is domestic inflow. Otherwise we have seen so much of FII selling, mainly led by US Fed tightening, and of course the interest rates are about to rise and liquidity is also going to get withdrawn. So I would say that in fact market has been very resilient, and so you are seeing ups and downs every day.
But retail investors typically tend to get a little jittery when these highly volatile situations arise.
Yeah, so correct, but they have kept faith up till now. Let's see how things move ahead. And the other point is, see, for example, there are some positives also. Like we have got a very stable government mandate, and so political stability is there. The government has been very business friendly, investor friendly of late. In last 2 years, I would say, the tax collections have been very strong. We have seen GST collections, income tax collections rising because there is a formalization of economy which is happening. The tax to GDP ratio is improving. And the other point which I would like to say, which is a positive, is that entire corporate India is mostly under leveraged. I have not seen Indian companies, or I think any other country also. The corporates are so much under leveraged, and so we are at the bottom of credit growth in a way, because up till now everybody was flushed with liquidity. Now you are seeing credit growth reviving, and people wanting to take risks as capacity utilization improves quarter on quarter, and because of so much of under leverage in the corporate India. So I would say that fundamentally Indian macro is also, I would say, very resilient this time. Otherwise, you would have seen that crude oil above $100, current account deficit widening, currency depreciating, all those things must have happened. But this time, due to good tax collections, due to good macro, India is holding on, I would say. And so retail investors have kept their faith.
But we are definitely looking at a fair amount of inflation across the board, whether it's oil prices, whether it's commodities, raw materials, all the companies are ailing under pressure. So, as an inflation hedge or protection against this rising inflation, what kind of sectors, what kind of themes you suggest people to look at, especially the retail investing community?
Yeah, so for example, I would say that there are sectors like IT, there are sectors like energy sensitive sectors, for example, upstream. Those kind of sectors actually don't get badly affected due to all this. In fact, if suppose there is a currency depreciation, there will be a good tailwind for IT sector in terms of their margins. So those are hedges, but I would say that, see, how market works is that when you feel that you should have a hedge in your portfolio, by the time that sector has already rallied. So I would say that what we at Prudential ICICI follow is that when a sector becomes cheap, very cheap and oversold, due to some worry, due to some short-term worry around, say, oil price going up, due to some short-term worry around FII selling because of higher interest rates in US, we try and buy the good quality stocks, the under-leveraged companies in those sectors at that time. For example, you must have seen that recently, you must have started reading a lot of reports about rural India picking up because of good monsoon, because of Russia-Ukraine crisis. Many crop prices have gone up. For example, cotton has gone up; it has doubled. Wheat has gone up. Various mustard prices have gone up by 30%. So on one hand, you will have good production because of good monsoon, and on one hand, farmers will benefit due to higher crop prices. Now, just 1 month ago, uh, you could have seen so many reports around the fact that rural India is suffering due to inflation, and there was a lot of weakness in rural facing sectors. But those were the times you have to buy. You have to keep faith in a company which is not leveraged, where you know the management that they have delivered since last so many decades, and you have to go ahead and buy that stock. For example, in the month of November, from November, we have seen huge selling in financials. Now, at the margin, I would say fundamentals for banks are only going to improve, right? The credit growth is at the bottom. You have just seen a print of 10% in credit growth after September 19 for the first time, because it is very natural that all commodity prices have gone up, so inflation has gone up, and so everybody needs more working capital, right? So credit growth has gone up. On one hand, RBI report says that capacity utilization is improving quarter on quarter, so that will lead to capex cycle at some point. So when there is a lot of selling going on in that sector, you get your good quality stocks at bargain prices, and that is the philosophy we follow at ICICI Prudential.
Okay. A lot of viewer questions are also trickling in, but first I want to understand. There is an FOMC meeting next month. Again, gold prices have been very high as well. Should investors now be watching out for for the Fed meeting as the next big event from a market standpoint, or should the focus still be on earnings and on the different commentaries that are coming in from various corporates?
No, I would
What do
say
you
that.
what do you
Sorry.
think is the next big event to watch?
No, see, Fed events are always big, right? Because ultimately it is a global liquidity which drives markets and all asset classes. So if the Fed events you cannot ignore, there is and earnings wise also, as we discussed already, there will be some pressure on corporate earnings also because of margin pressure. Of course, there are some set of companies which will benefit, but definitely there will be some pressure on earnings also. So I would say that uh, things are not as easy, but you have to be very humble and nimble-footed, and just keep searching for values when market throws at you those prices of a good quality businesses. That is the only way to go.
Mr. Thakkar, I'm looking at your, funds that you manage as well. If I look at the large and mid cap fund, you have a fair amount of exposure to banking, financials, and insurance space. About 37% exposure there, and there are big names like State Bank of India, ICICI, HDFC, SBI Life is also featuring in one of your top holdings. So, talk to us about what's happening in the banking space. You did mention that credit growth is likely to come back, but it's something that even we have been hearing from managements for the last 7-8 months now. But has it really come back meaningfully? Are there enough signs to believe it?
See, first of all, in investing, we at ICICI Prudential have a view that when things become clearly visible, then there is no value left. So you have to buy when things are not so visible, and that is what it is, right? In financials, especially, and see, we have increased our weights from the month of November when we saw that FIs were selling because of their own compulsions of higher interest rates in US and liquidity withdrawal. But at the margin, the fundamentals of Indian financials are only going to improve, because see, we had a 10 years of bad performance in terms of asset quality, right? All those corporate lending which was done 10 years ago gave pain up till now. Of course, some banks did not do that funding, but I would say that after 10 years, and now all the government projects which we are seeing have good, I would say, good bankability. And so I would say that corporate India, we were just discussing, right? Corporate India is completely non-leveraged. If you see the leverage numbers of any Chinese company or something, and you see the leverage levels of Indian companies, even commodity companies like steel and aluminum, the debt has reduced meaningfully. uh, Refining, and on one hand you see capacity utilization in refining, we are hearing capacity utilization of 105% in refining, in textiles, in various sectors, if you see renewables. So I think yeah, we are at the cusp of capex cycle. And on the other hand, the clear benefit which will come is that this time the asset quality problems are not there at all. So the large part of the corporate NPA cycle is behind, and so you will have a double benefit, that your top line will grow because credit growth will come back. And we have seen yesterday's print itself, it is at 10%. It's first time it has come after September 19, double digit credit growth. So on one hand you have a top line growth, and on one hand you have a bottom line growth, because there'll be reduction in the provisioning or credit cost, because NPA
Hmm.
cycle repeat. So I would say that fundamentally things are only going to improve. While because of ownership of FIIs, there is a heavy ownership of FIIs in this sector, and they are selling. So, and these are liquid stocks which they can sell easily in the market, and so that selling is going on. So there'll be some pain for some point, for some time, but I think eventually this sector should do well.
Our viewers here, specifically the ones who are from a retail segment, they want actionable ideas, they want actionable strategies. So when it comes to investing in banks, where do you think lies most amount of value when it comes to BFSI? Whether is it banks, is it NBFCs, is it insurance, is it any tech-based companies that you like? Where should investors park their money? Where is the next big multi-bagger, perhaps?
Yeah, so basically, I cannot recommend stock specific, but I would say there is great value in both private sector and public sector banks, which have very good deposit franchises, which have very good CASA, I would say, because CASA derives your cost of funds, and you are in a cycle where interest rates are going to rise. Clearly, the high CASA banks will benefit when interest rates rise. And as I said, asset quality problems are behind, and top line growth is just about to start. So we remain very constructive on that space.
Okay. One very interesting thing about, the large and mid cap fund and the holdings that you have is that HCL Technologies was the only name from the IT space. Can you tell us about why you like this company? And they delivered their numbers yesterday. The commentary has been rather moderate, I would say. It's not very encouraging. Long-term story, yes, looks largely okay, but right now the street is in two minds about the prospects with HCL Tech. So, what is it that makes you optimistic about
I'm sorry, basically, we cannot discuss stock specific here.
it?
Uh, so I would not like to discuss stock specific, but I can give you a general idea about IT space. The demand environment looks very strong. There is no doubt about it. Yesterday, Mr. Powell has said that US economy is in very good shape. Large part of Indian IT businesses revenue comes from US. Plus, I would say that there is nobody who can compete with India in this space. We have a low cost people, educated people working, and so we have a scale advantage. Plus, I would say that IT companies generate huge amount of free cash flow. Some companies generate 20,000 crore of free cash flow. Some other companies generate 30,000 crore worth of free cash flow. So it's a huge amount of free cash flow generation. They don't need capex. They don't need any big investments to grow. So you will see some companies having a 85% dividend payout, 90% dividend payout, or some companies doing buybacks. So the entire profit, most part of the profit is returned to shareholders, and still they are growing at, I would say, healthy double digit growth rate. So it's a great sector to be in. Of course, valuations matter. In between, there was a time when, especially mid cap part of that space, was too much overvalued, and now that correction has happened. So, and it might happen further. So I would say that if you stick to good companies in that sector, in long term, it should do good for you.
Okay, all right. Let's also talk about the Bharat Consumption Fund. And before we talk about the various constituents and the segments that you're betting on, what is it that makes you optimistic about Bharat consumption story? Because right now the demand is pretty much mellow or moderate. It's yet to pick up meaningfully after the pandemic and from the impact of the pandemic. Various pockets, whether it's rural, barring essentials, I think discretionary spending is yet to come back in a meaningful way, whether it's autos, electronics, jewelry, etc. So, why is it that you like the consumption story, and what are the big triggers that you're identifying?
Correct. So as we spoke, we have to buy before the numbers actually start looking good, and that is why, for example, in FMCG or consumer sector, I would say, which is either rural facing or urban facing. So we saw good value during recent correction, where markets were very, I would say, upset, because crude oil went up above $100, stayed there. Demand was very weak because rural India was suffering from inflation and after effects of COVID. During those uncertain times, if you pick up good quality stocks of that particular sector, then it helps you a lot when things come back. And you don't know when things come back, right? Now we are seeing that due to this Russia-Ukraine crisis, the agricultural some crop prices have shot up, like cotton, for example, wheat or mustard, and all those prices have gone up. Plus, the monsoon is expected to be good. So now we are seeing, generally the market is sensing that rural India might recover. So there are some two-wheeler stocks in our portfolio, FMCG stocks in our portfolio, which we have actually bought during this correction of last 4 5 months. So I would say that give it some time. If the company is good, if the balance sheet is not having too much of leverage, if the cash flows are genuine and growing, give it some time, and I think they will start showing results.
Okay. But autos are a significant part of the fund. Can you talk to us about the outlook for autos? Because the semiconductor shortage still is an issue. EVs look like there is still some time before they see any meaningful pickup in demand or in acceptability. So, what is it that you like in the auto space right now?
Yeah, so our portfolio, Bharat consumption, is overweight on two-wheeler stocks, because we have, as you see, from last 3 years, two-wheelers have seen a significant amount of pain. First, the insurance costs went up, then steel prices shot up, affecting the margins, and rural demand was already weak. Colleges were closed, so there was no demand from youth, and finally this chip shortage. And we feel that when so much of problem happens to a sector, and of course EV disruption, as you rightly said, so many problems happen to the sector, then market gives you that kind of price, which you are comfortable buying at, even if these problems continue for a while, right? We are not there to just buy and we want a return in next quarter itself, right? We are ready to ride through this volatility, and build up a portfolio of companies which are bought at good prices, good attractive P multiples, where we can give it a time and we can ride through this uncertainty. And when the time comes, they will start giving us good benefits because the companies are really good. They are very strong brands. They are good distribution network. They are not leveraged at all. In fact, some of them are very high in terms of net cash. Return ratios are very good. It is just that last 3 years have been very bad for the industry. Now, if you see colleges opening, right, people are going to buy two-wheelers. Or if you say rural India will recover, the two-wheeler sales will increase. That is the time market will take note of it and stocks will start giving you returns.
Hmm. There are some viewer queries coming in, Parag, that I'd like your view on. First up, once again, focus back on technology. Our viewer wants to know, will new age tech companies see more correction? It's a very valid question because the way they came down crashing in the recent market correction was very unnerving, especially for new investors. So, is it something that you track or you would like to share your insights on, new age tech?
No, I don't track that space very closely. But I would say that see, we have been in a phase of very easy liquidity, 0% interest rates for last decade or so, and this gave rise to a lot of money which can go into the sectors which actually don't generate cash flows, but they actually present a very large opportunity in coming time. So people were ready to chase those opportunities at very high valuations also. And so that part of the market was affected because when Fed said that, now they want to tame inflation at any cost, they want to increase interest rates, and they'll start quantitative tightening also. So when the value for money rises, then money chases cash flows, right? So if there are no cash flows, if there is no predictability of earnings, definitely your valuations will come down. So I'm not saying that every US tech company is not generating cash flows. Many of them might be generating good amount of cash flows, but the multiples which were assigned to those cash flows was very, very high.
Okay. Another question coming in is within the auto space, the auto ancillary space. Our viewer wants to know your view on the battery companies. You spoke about two-wheelers and why you're betting big on it because of the Bharat consumption story. But are you also tracking battery stocks?
See, I'll tell you again, stock specific, I'll not like to repeat, but the point is that generally there are some sectors which are affected by EV disruption. And there are some sectors which, irrespective of EV or a normal engine, those auto comps will be consumed. So I would better bet on those auto component companies where the consumption is not going to be affected, whether it is electric engine or whether it is normal engine. So definitely, I would like to bet on companies which are suppliers to both uh, technologies.
I also understand your view on mid caps because a significant part of your fund has exposure to mid cap names, and these are the ones which are, yes, they are very high, on returns, but they're also very big on volatility. Whenever the market corrects, whenever there is any uncertainty, mid and small caps are the one to react most sharply. So when it comes to investing in mid caps, should you apply the same strategy as you do for investing in blue chip companies, or should you be more specific about each of them and have a different strategy perhaps?
No, so basically, I completely agree with you that whenever there is a volatility, mid caps and small caps are bound to give you more volatility. But I would say that this time, after the month of November, what we have seen is that there is a FII selling, and FIIs own large cap blue chip companies. That is why you see that large cap blue chip companies, some, I would say not all, are going through a lot of correction, while their mid caps and small cap counterparts are holding on because they are being held by domestic mutual funds or retail investors or HNIs, and there is no compulsion to sell in that particular category. So FIIs are selling, and so large cap blue chips have become more attractive from longer term point of view. And so you can see that in our large and mid cap also, the highest proportion is large cap and not mid cap or small cap. In fact, small cap is a very small portion. That said, you are right that bottom up opportunities will always exist in the market. You cannot say that entire mid cap basket or small cap basket is very expensive and so you should sell that. But right now, where we are in the market, we see more value in large caps because there is a huge FII selling which is occurring in large caps, bringing the stocks of those blue chip stocks to a very attractive levels, while mid caps and small caps are holding on.
Okay. Are you also tracking the QSR space? Because one of our viewers is asking if there's some insight that you would like to share on QSRs at large.
Yeah. So it's the space wise, it is very attractive, no doubt. Because as we see formalization happening in every segment, QSR is a space where there is a huge opportunity. It can grow at double digits for a decade. Because we have seen during COVID, so many restaurants have closed down, and people want to eat branded food from health perspective also. So I would say that there's a good opportunity. India is just a $57 billion industry in terms of fast food segment QSR space. So it is likely to grow very nicely. The thing is that you have to spot the opportunity where the cash flows can be generated, where capex is not too high, leverage is not required, and return ratios are good. So if you find such company in the QSR space, because the space is going to do well, it is just that finding that right stock in that particular segment. So if you can find a right stock in that segment, you're good to go.
Okay, makes sense. You know, you've been a fund manager for many years now, but talk to us about the opportunities that market volatility and times like this provide to investors, not only to invest in equities, but across asset classes, whether it's gold, which has seen a phenomenal run up, or any other commodities, or mutual funds, of course. So, talk to us about how new investors should go about building their portfolio amid uncertainties and amid seesaw movements that we're looking at in the markets currently.
Yeah, so see, time and again, what we have seen is that there is a extreme pessimism in some asset class. And so that extreme pessimism gives you a very good opportunity to enter into that asset class. So whether it is gold or whether, for example, just to give you an equity example, when demonetization was announced, there was a complete panic in the market, right? It was looking like, as if people are going to just postpone their demand for normal consuming goods like soaps and detergents or toothpaste forever. And it was never going to be the case, right? You are never going to postpone your demand for such FMCG items forever, or say for cars also forever. It gave fantastic opportunity in domestic consumption stocks to buy those things. Then again, during COVID, for example, IT stocks corrected significantly. Uh, then people realized that IT is actually a big beneficiary of COVID, right? Because everything became digital. The IT spending went through the roof. This entire buzzword of digital and cloud came into picture, and see how much wealth IT sector created post COVID. So I would say that wait for such extreme pessimism in a particular asset class, and then start buying, because in equity or in this part of the, I would say, any cycle of any asset class, uh, to those extreme pessimistic points are where if you start investing you make a fantastic money.
Okay, makes sense. Uh, as far as the earnings season is concerned, and your view for the next 2 to 3 quarters is concerned, what are the big trends or the big themes that you will be closely tracking?
Yeah, so I would be closely tracking, I would say, as we discussed, banking and financials, because again, I would like to say that credit growth is just about to revive and asset quality problems have peaked out. Uh, Second is, for example, rural India, where there was a lot of pessimism, and now things are changing on the margin. Third, of course, is capital goods exports. For example, I would say that if you hear any multinational company in their earning calls, and if you listen to them, everybody is talking about India becoming a cheapest cost producer in their global landscape, and so every capital goods company is seeing good exports from India to their other counterparts. So I would say that this is another third theme which I would like to be more focused on. Of course, there are market related, for example, IT sometimes, or sometimes FMCG or auto. Those sectors always will keep presenting those opportunities. But I would say that in the sectors which are beaten down, in the segments where you really find value in the market, these are the three segments I would like to monitor closely.
Okay. On that note, we'll conclude this conversation, Parag. It was great chatting with you and getting so many insights from you across different pockets, different sectors and stocks. Thank you so much for joining in, and thank you for addressing our viewers' queries and questions as well. I'm sure they would have got a lot of help from your insights today. Thank you guys for tuning in. That's all for today. Have a great weekend.
Thanks a lot.